Welcome to a new episode of the Metalli Rari podcast. For millennia, gold has been, the foundation of wealth, the ultimate store of value. It's an obsession for investors, empires, even central banks. But today, we're doing a deep dive into an inescapable truth. Gold is breathtakingly scarce.
It really is. We've gone through a stack of sources, World Gold Council data, market intelligence reports, and what they show is, frankly, startling. We're talking about the sheer physical limits of the world's supply, the incredible speed of modern extraction, and, well, the market factors that drove its value.
Right. And specifically, we're looking at what our sources say caused that price surge past the historic $4,000 an ounce mark back in 2025.
Exactly.
Our mission today is pretty straightforward. We want to give you a really concrete visual way to understand just how finite this resource is and, why that scarcity, when you combine it with global uncertainty, is driving its value to these new highs.
We're looking at what's left, where it is, and why everyone from central bankers to everyday investors just fled to it during that rally.
And to start, we have to drop the core aha moment right now. Forget treasure troves, forget bottomless mines. If you took all the gold ever mined in human history
Everything, from ancient artifacts to the gold in your phone.
and melted it down into one single perfect cube, that cube would only be 22 meters on each side.
It's an incredible image. That's about 216,000 tons of gold, and that represents almost 3/4 of all the known resources on the entire planet.
So that whole cube, all of humanity's golden wealth, could basically fit inside a professional sports arena.
Comfortably. It just shatters that myth of abundance. It's a stunning visual for how limited this asset actually is.
It really puts our whole obsession into perspective. Okay, so that 22-meter cube is what we've already taken out of the ground. But what about the other cube, the one that's still underground? What does the data say about that?
Well, that's where it gets even more interesting. The remaining reserves that we think are, economically exploitable.
Meaning we can actually get to it without losing money.
Precisely. That amount is just 64,000 tons. If you melted that down, your cube would only be 15 meters on a side.
15 meters. So this huge drop from the 22 meters we already have.
A huge drop.
And just for context, if you've ever seen, say, the Great Pyramid of Giza, that stands at 139 meters tall.
And there you have it. You put these two little golden cubes next to a single ancient structure, and the idea of gold as a finite good becomes undeniable. It's not an abstract economic theory anymore. You can see it.
You really can. And what we found in the sources is that we've been tearing through that resource at an incredible pace. It feels like we're in a modern gold rush.
We are. It's a phenomenon of the technological age. The industrial boom after World War II it completely changed our capacity for mining.
How dramatic a change are we talking about? Like, what percentage of all the gold in that big cube has been pulled out just since, say, 1950?
Almost 70%.
70.
In just about 75 years, we have extracted 2/3 of the known supply. This was all driven by huge investments in new techniques, open pit mining, better refining processes that could handle lower quality ores.
That is staggering. But if our tech got so much better, why are new extractions slowing down now?
Yeah.
It seems counterintuitive.
Because technology can only fight geology for so long. The easy stuff, the low-hanging fruit, is gone. It's been mined.
Right.
So today, companies have to dig deeper in tougher places, and they have to process so much more rock to get the same tiny amount of gold.
And this is where that technical term from the sources comes in, right? The drop in the tenor of the ores.
Exactly. The tenor is just the concentration of gold in the rock. Decades ago, you might find several grams of gold per ton. Today, you're lucky to find a fraction of that, which means higher costs for everything: energy, labor, chemicals, just to get 1 ounce.
So costs are going up just as demand is exploding. Okay, let's shift from underground to above ground. We have our 216,000 tons. Where is it all now?
Right, so we move from geology to the economy. That big 22-meter cube is basically split into 4 main buckets.
And I think most people would guess it's all in government vaults like Fort Knox, but that's not the biggest piece of the pie, is it?
No, not even close. It's mostly ornamental. About 45% of all gold is held as jewelry. That's the biggest slice. After that, 22% is for investment bullion, coins, that sort of thing.
Okay, and then we get to the big players, the ones who really move the markets.
Then you get the central banks. They hold about 17% of the total supply. And they use it strategically. It's a hedge against inflation, sure, but more and more it's a safeguard against geopolitical instability, a real break glass in case of emergency asset.
And the last bit is for industry and tech.
Correct. A growing slice goes into electronics, aerospace,
Yeah.
places where you need its unique properties. But it's that central bank and investment piece, that 17 and 22%, that directly connects to the price surge we saw in 2025.
That rally was one for the history books, crossing $4,000 an ounce for the first time, a jump of over 50% in a really short time. That's not just a market correction, that's a stampede.
A jump like that points to a perfect storm. It was a combination of a weakened dollar, general economic uncertainty, and, most importantly, some very serious geopolitical tensions coming to a head.
Let's dig into those tensions. Because when you say central banks hold 17%, you're really talking about global trust. When that trust starts to break down, what were the big moves that drove this demand?
The main strategy was de-dollarization. The most obvious player, according to the sources, was China. They were systematically reducing their holdings of U.S. treasuries and just relentlessly buying physical gold. It's a clear strategic pivot away from dollar dependency.
And when a player like China makes a move that big, it has to cause ripples.
Oh, absolutely. The U.S. sanctions on Russia after 2022 were a huge wake-up call for almost every emerging economy. They saw that sovereign assets held in Western banks could be frozen overnight.
So they needed an asset that nobody could control digitally.
Exactly. They needed a tangible guarantee that exists outside any one government's reach. And on a global scale, gold is the only asset that really does that. It was fulfilling its ancient role as pure monetary metal when faith in everything else starts to wobble.
And you can't forget the retail investor in all this.
Yeah.
When you have governments de-risking and regular people getting scared, that's a lot of pressure.
It's immense. Retail investors were getting hammered by sticky inflation. They saw their purchasing power just draining away, so the impulse to buy something tangible, something unprintable like gold, created this massive wave of demand from the ground up. Put it all together, and $4,000 an ounce wasn't just possible. It was probably inevitable.
Okay, so given this intense scarcity, our two little cubes, the future is all about the supply challenge. We know there are 64,000 tons left in reserve. But are there big undiscovered stashes out there?
Well, there's definitely more gold in the ground. The key word, though, is reserves. A deposit only becomes a reserve if it's economically viable to mine. The price has to be right.
So that 2025 price rally was actually a signal to the mining industry itself.
It's the ultimate stimulus. When the price shoots past $4,000, all these low-grade deposits that were worthless before suddenly become profitable. That price hike unleashes exploration budgets, it funds R&D into new recovery tech. It basically expands the economic supply, even though the physical amount of gold on Earth hasn't changed.
That makes sense. The market literally changes what's possible. But even so, we're still running out of the easy stuff.
Which brings us back to what we already have. The sources really stress the importance of recycling.
It's identified as the central challenge for the coming years. With new mining getting more expensive and environmentally damaging, getting the gold that's already in circulation back into the system is, well, it's no longer just a good idea, it's essential.
And we're not just talking about melting down old necklaces.
No, not at all. We're talking about urban mining extracting gold from e-waste. Your old smartphone, your computer. It's technically very difficult right now, but it's an incredibly rich, above-ground mine that we have to get better at tapping. So what does this all mean for someone listening? We started with these two tiny cubes to show the physical scarcity.
And we end by seeing how that scarcity, when it collides with geopolitical fear and institutional demand, creates this incredible volatility. The gold price isn't just about inflation anymore, it's a barometer for global stability.
So the total amount of gold is fixed, the big cube and the little cube. But the amount available to the market is always changing, depending on how much trust there is in the world.
Exactly. So here's a final thought to chew on. Since 1950, we've mined almost 70% of all gold. The 2025 rally showed how fast geopolitical fear can swallow up supply. Are we getting to a point where recycling, not new mining, will be the thing that determines the stability of global finance? We've sort of hit the geological wall. Now we have to manage what's already in our hands.